Hey everyone, and welcome back. Investing can be extremely overwhelming, especially when you're getting started as a beginner. There is so much information that you can get access to. There will be so many things you don't understand. And on top of all of that, there will be things you think you understand, but are actually misinterpreting. So in today's video, I want to break down 4 things that I personally wish that I knew when I got started investing a few years back. So that's what we're going to get into in today's video, and I won't waste too much of your time with a long intro. So if you enjoyed today's video, make sure you leave a like on it and let me know your thoughts down in the comment section below. But with that said, let's get straight into the video. So the first thing that I wish I knew when I was getting started with investing is that I didn't need to pick individual stocks. I didn't need to be a stock picker. And I know that that's kind of the lure, the attraction of the stock market to a lot of beginners is the prospect of being able to analyze and pick individual businesses and identify the business that's going to explode and go up 100 times on their stock price, and the business is going to become a huge success. I know that's kind of the excitement and the lure of the stock market, but as a beginner, it is actually really, really risky at its core to try and pick individual businesses right off the bat. And there's a number of reasons for this, but the main reason and kind of the overview of all of the reasons is that you won't know how to analyze that investment properly. And when I'm saying you won't be able to analyze that investment properly, what I'm really saying is you won't be able to identify a competitive advantage in that business. You won't be able to assess management. You won't be able to do a good and reasonable estimation of the future cash flows of that business, and you won't have a deep understanding of how it operates. And all of those things combine to say that it's a bad idea as a beginner to try and pick individual businesses. More likely than not, you will do a poor job at analysis, or you won't do any analysis at all. And as a result, that will cause you to make some bad decisions and lose some money in the markets. The good news is you don't need to understand individual stock analysis when you're getting started. You can invest in something called an index fund. Now, an index fund, for those who don't know, is a collection of businesses, an investment in a collection of businesses that tracks a certain index. So most commonly, you will have something like the S&P 500 index, which tracks the top 500 or 500 of the biggest companies in the United States. You have something like the ASX 300 in Australia, which is the 300 largest companies on the Australian stock market. And for 99% of people out there, starting and finishing with index funds, honestly, is going to be the way that you want to go about investing. Just investing on a free market economy. Basically just betting that either the US or Australia is going to be significantly more productive, producing more, innovating more in the future over the long term than they are now. And that has historically been the case for countries like the US and Australia. And if you're focusing on index funds that track free market economies with a very long track record of growth, then you're probably going to do quite well over time, consistently investing in those vehicles. But index funds are not just suitable for people who don't want to analyze individual stocks. They're also suitable for people who eventually want to have a portfolio of individual businesses. And the way that you should think about this is when you're getting started, you should want to build the foundation of your portfolio that isn't reliant on you making good decisions on individual businesses. And that's why you should start, or you can start, it's an option, with an index fund. Consistently contribute to it, have it as a certain percentage or of your portfolio as kind of a foundation, as a baseline. And then you're in no rush to find and invest in 10 different stocks immediately. You can take your time. While you're still learning how to analyze businesses and you're still searching for that first great investment, you can just consistently contribute to investing in essentially the top US businesses, the US economy or the Australian economy, or whichever one it is. So you can just contribute to that. You're going to be in no rush to run out there and build a portfolio of individual businesses. And going about it that way, having much more patience when it comes to picking individual stocks, you will far less likely make a bad decision early on in your investing lifetime. The second thing that I wish I knew when I was getting started is that stock prices are irrational most of the time. So when I got started, I think like a lot of people, I thought that stock price movements all the time were representations of changes in the value of the underlying business. So if a stock that I had went down 5%, I would think that I had done something wrong. And if a stock went up in the short term, 5%, 10%, whatever it was, I immediately thought I was a genius, that I had made the right decision buying that stock 10% lower the week before. Now, of course, what I found out later was that most of the time, especially in the short term, the stock price movements are highly irrational and have absolutely nothing, in many cases, to do with what is actually happening with the underlying business. And on a daily basis, most stock price movements are irrational. Same on a weekly basis, same on a monthly basis, even on a yearly basis. A lot of the time, stock price movements are irrational, meaning the performance of the business can be very, very different in a given year, in a 12-month period, to the movement of its stock price. And the only period that I can see, or that I've seen so far, in which a stock price is mostly representative of the performance of the underlying business is over a 5 or 10 year period. If you look at a 5 or 10 year chart for any stock, in most cases, and this is not always the case, but in most cases, the stock price moves in the same direction as the increase or decrease in profitability of the underlying business. So how profitable is the company? If they're producing more profit 5 or 10 years down the road, their stock price is likely, in most cases, going to move in that direction to reflect the underlying business. But in the short term, over a week, over a day, over a month, even over a year, even over 18 months in some circumstances, the stock price movements of a business can be very different from the actual underlying business. And I think the important lesson here is that you cannot judge an investment decision that you've made in the short term by only looking at the stock price. Because in many cases, if you're looking at the stock price movement for less than a year, as we've spoken about, in many cases, the stock price is not going to be reflective of the actual performance of the business, which is what will drive the stock price over the long term. So whenever you're looking over a year or less, or even over the long term, whenever you're looking to assess your ability to make a good investment decision, you should look to the business. You should see how their revenues, their earnings, their cash flows, their equity, how are those figures growing over time? Is the management team getting more efficient? Is the return on invested capital going up? Is the company lowering their debt and reducing the risk to shareholders? These are the things that you should be using to assess whether you've made a good investment decision, because over the long term, it's those things that will be reflected in the stock price. But in the short term, those two things can be very, very different. The third thing that I wish I knew when I was getting started, the third thing on our list here today, is to avoid penny stocks. Now, this one's not exactly true. This one's just more of a PSA for beginners, because I fortunately was not lured into investing in penny stocks when I was getting started. But penny stocks are just pure evil. They give you the slightest hint that you have the chance to invest in a company and make hundreds of thousands of %, that you could just pick the right penny stock and you would be rich. You put 1,000 in, you pull out $1 million in 2 years' time. And it really does seem easy for a beginner to invest in a penny stock and make a ton of money. It seems so easy, right? It's just a 5-cent stock. It just needs to go to 50 cents. That's all. If each share was just worth 50 cents, I would be 10 times richer. It seems so easy, but it's a complete lie, and it's a terrible idea for any beginner, for anyone at all, not just beginners, anyone at all, to look and invest and trade in penny stocks. And I'm going to explain 3 key reasons why it's a terrible idea. The first reason is that often these penny stocks do not have a business that can yet run profitably. So they haven't reached the point where the business is actually a viable business. Most of these businesses, they're in early stages. They might be making some revenue, but some penny stocks don't even make any revenue. But they might be making some revenue, but their expenses are far more than their revenue. So they're losing money every single year. They haven't figured out quite yet how to make profit in that business. And that is super risky, because if they have no track record of making profits, what's to think that they're going to suddenly be able to turn around and start making a profit? And the reality is that in most cases, most businesses never get to the point where they are profitable. And that kind of neatly leads us into the second reason why penny stocks are a terrible idea. And that is that often they will raise equity and dilute the shareholders. So when these businesses are running low on money, when they're losing a ton of money, they'll look to find debt in order to stay afloat, but they'll also just sell more shares. They'll just create more shares. And that means that your percentage ownership goes down, and that can affect you significantly. It even happens for really, really big businesses. Flight Centre, for example, just doubled the number of shares, halving the value of each share for shareholders. So if it happens to businesses as large as Flight Centre, you betcha it happens at a much higher rate in penny stocks, in really, really small companies. And then the third and final reason is that there is really low liquidity in a lot of penny stocks. So low liquidity basically means that it can be very hard to find a buyer or a seller for that stock. So if you want to get out of that stock and you have a significant position, you have $10,000 invested in there or $100,000 invested in there, it might take a long time for you to find a seller, a buyer, I should say, to buy that stock. And you might not be able to sell that stock at the current market price. You might have to sell it at a substantial discount to the current market price. And that, of course, again, is a big problem. And then the fourth and final thing that I wish I knew when I was getting started with investing is that most people who are investing, buying and selling stocks in the market, most of them are short-term focused. Okay, so what I mean by that is most investors are looking at the most over a 3-year period. They're looking 3 years out. So what that means is they're looking at the company today and they're thinking about, well, what can it grow its profits to in the next 12 months? What can it grow its profits to in the next 6 months? What can its stock price do over the next 2 years? So most investors, institutional and retail investors, this goes for both, especially institutional investors. A lot of them are focused on the next quarter, not even on the next year. But a lot of people are looking very short term. And as a result, a lot of people just get out of businesses when there's a short-term problem going on. So if there's a recession, that's why businesses sell off so quickly during a recession. And then while the recession is still going on, stocks will usually recover, because as soon as there is a light at the end of the tunnel, as soon as it looks as though 2 years out, 3 years out is going to be really, really good, people start buying those stocks again. But during the period where the next 12 months looks terrible, most investors are selling out of those stocks. And as a long-term investor, you can use this to your advantage. So instead of being the person who is scared of a short-term problem happening within a business, what you can do is, first of all, you need to find a great business. So making sure you have a short list of great businesses that have low debt, a great management team that knows what they're doing, they're trustworthy, they're being honest with you. The business has a product or service that has a distinct, unique feature that customers are attracted to, that ensures that customers are going to be coming back after the short period. And instead of fearing that short period, 12 months, where it's going through some kind of problem or they're receiving less sales because there's a recession going on, you can just buy into that business knowing that it's likely going to be substantially stronger 5 or 10 years down the road. And these short-term problems can take its form in a number of different ways. It could be a broad economic problem, a recession that's causing a lot of different industries, a lot of different businesses to have a terrible 12 or 18 months. Kind of like what we're seeing at the moment. A lot of different types of businesses are struggling this year. It's a short-term problem. The pandemic is not going to last forever. We don't know when it's going to end at this point, but it's not going to last forever, that's for sure. And if I'm looking 10 years out, I'm pretty sure that we're not going to be dealing with this pandemic. There might be something else at that point, but we won't be dealing with the pandemic. But the short-term problem could also be industry specific. There could be a material that business uses, like steel or aluminium, that has a shortage, or maybe someone puts a tariff on imports or exports of those materials, and that causes an increase in the cost for a short period of time. The short-term problem could take its form in a number of different ways, but ultimately what you're looking for is a problem that is has a finish point. So it might last 12 months, but it's got a point at which things will turn around. And you, of course, want to look for businesses that have a stock price that's gone down during that short-term problem so that you can invest in it. And if you have a long-term perspective, then it doesn't matter if you buy that stock and it goes down for the next 12 months. Why do you care? Why does it matter what the stock does over the next 12 months? In fact, if it's a great business and the stock continues to go down, that's a great opportunity to invest some more money. But either way, if you've done your research, it's a great business and you have a reasonable estimation of future cash flows, you've done your intrinsic value calculations, then you would know that 5 to 10 years out, once the short-term problem is far in the rearview mirror, that business is going to be far stronger than it was before. And all of those short-term minded investors are going to be coming right back when the growth continues in that business. So that is all for today's video. I hope you enjoyed it. And as always, if you did, I would very much appreciate it if you could leave a like on the video and then head down to the comment section and let me know your thoughts on this video and what are some of the things that you wish you knew when you were a beginner, when you were getting started, if you've been investing for a little while. And of course, if you have any questions around investing, I'll be answering questions as this video goes live. But other than that, I hope you guys have a great day and I'll see you in the next video.